At the start of the 20th century, Britain sat at the center of the global economy. Its currency settled international trade. Its banks financed governments. Its ships controlled the sea lanes that moved raw materials and finished goods across continents. From the outside, this looked like permanent dominance. Wealth appeared stable, institutions appeared mature, and power seemed self-sustaining. But beneath that confidence, the financial structure of the empire was already changing. Britain was no longer growing rich by making things. It was growing rich by lending, by insuring, and by extracting returns from past advantages. Capital flowed into London faster than it flowed into factories. Profits came increasingly from paper claims rather than productive output. This shift felt sophisticated at the time. Finance was cleaner than industry. Overseas investments felt safer than domestic rebuilding. Debt looked manageable because the empire had always paid its bills. Yet this quiet preference for financial extraction over real production planted the seeds of long-term weakness. This story is not about a sudden collapse. It is about how repeated financial choices, made in comfort and confidence, slowly hollowed out the richest empire the world had ever seen. By the early 1900s, Britain had reached a strange position. It owned vast territories, controlled global trade routes, and earned enormous income from abroad. Yet at home, its industrial base was aging. Factories that once led the world were no longer being modernized at the same pace as those in Germany or the United States. Instead of reinvesting heavily in domestic production, British capital increasingly flowed outward. Money earned from trade and empire was lent to foreign governments, railways, and businesses overseas. These investments produced steady interest and dividends, reinforcing the belief that Britain had discovered a superior way to generate wealth without strain. This created a subtle imbalance. Other nations used borrowed capital to build new industries, modern infrastructure, and productive capacity. Britain, meanwhile, grew more dependent on financial income generated by assets it already owned. The empire was living off returns from the past rather than building strength for the future. At the time, this did not feel dangerous. London remained the world's financial center. Sterling was trusted everywhere. As long as interest payments arrived on schedule, few questioned whether the underlying economic engine was slowly losing power. The First World War exposed the weakness that had been quietly forming for decades. Britain entered the conflict as the world's banker, confident it could finance a long war. And for a time, it did. But the scale of modern industrial warfare consumed resources at a pace no previous empire had faced. To keep fighting, Britain borrowed heavily, especially from the United States. Gold reserves drained away. Overseas investments were sold to pay for weapons, food, and fuel. What had once generated steady income was liquidated under pressure. The empire was converting long-term wealth into short-term survival. When the war ended, Britain emerged victorious but financially transformed. It was no longer the world's primary creditor. It had become a debtor. The global financial center had not moved overnight, but the balance had shifted. Confidence remained, but the foundation was thinner. Rather than adapting to this new reality, Britain tried to restore the old system. It aimed to return sterling to its pre-war status and resume its role at the center of global finance. This decision would lock the economy into policies that prioritized appearances over economic health. In the 1920s, Britain attempted to reclaim the world it had lost before the war. The government pushed to restore the pound to its old gold value, believing credibility mattered more than flexibility. On paper, this signaled strength. In reality, it imposed severe strain on the domestic economy. An overvalued currency made British exports expensive and uncompetitive. Industries already weakened by years of underinvestment struggled to survive. Wages were pressured downward. Unemployment remained stubbornly high, not as a crisis moment, but as a permanent condition in many regions. Financial interests in London were largely protected. The priority was maintaining confidence among creditors and preserving the image of stability. Industrial communities paid the price. Economic pain was spread quietly, unevenly, and politically tolerated because it did not immediately threaten the financial core. This period marked a critical turning point. Britain chose to defend its financial reputation rather than rebuild its productive base. The empire still looked wealthy from the outside, but its internal strength was eroding in ways that could no longer be easily reversed. The consequences did not arrive with panic or headlines. They arrived as paperwork. Government reports showed rising welfare costs tied to long-term unemployment. Tax receipts from industry stayed weak. Trade deficits became routine rather than temporary. Inside Whitehall, officials reportedly understood the imbalance. Memos circulated noting that Britain was importing more than it exported and borrowing to cover the gap. The solution was rarely structural change. It was short-term financing and confidence management. For ordinary people, this shift felt personal. A steelworker in South Wales could find his factory closed while banks in London expanded. His wages stopped. His mortgage remained. Credit bridged the gap where income once stood. Debt quietly replaced growth as the stabilizing force. It kept consumption steady and avoided social shock. But it also tied the country more tightly to lenders and financial markets. Stability was maintained, yet something fundamental had been traded away. By the 1970s, the strain could no longer be disguised. Inflation rose sharply. Strikes disrupted transport, power, and manufacturing. The balance between wages, prices, and productivity broke down in public view. In 1976, the pressure reached a defining moment. Britain approached the International Monetary Fund for emergency support. According to official statements, this was not insolvency, but it was a loss of independence. Economic policy became conditional. Inside government offices, spending plans were rewritten. Limits were imposed. Confidence replaced growth as the central objective. Observers recalled the quiet shock of realizing that national choices now required external approval. For households, the moment felt confusing rather than dramatic. Mortgages adjusted. Prices changed weekly. A shop owner might relabel goods twice in a month. The crisis passed without collapse, but the message was clear. Britain could be pressured when markets lost. By the 1970s, the strain could no longer be disguised. Inflation rose sharply. Strikes disrupted transport, power, and manufacturing. The balance between wages, prices, and productivity broke down in public view. In 1976, the pressure reached a defining moment. Britain approached the International Monetary Fund for emergency support. According to official statements, this was not insolvency, but it was a loss of independence. Economic policy became conditional. Inside government offices, spending plans were rewritten. Limits were imposed. Confidence replaced growth as the central objective. Observers recalled the quiet shock of realizing that national choices now required external approval. For households, the moment felt confusing rather than dramatic. Mortgages adjusted. Prices changed weekly. A shop owner might relabel goods twice in a month. The crisis passed without collapse, but the message was clear. Britain could be pressured when markets lost. When these moments are placed side by side, a pattern becomes visible. Britain repeatedly chose financial credibility over productive renewal. Each time pressure rose, the response focused on stabilizing markets rather than rebuilding capacity. The same sequence appeared across decades. External borrowing filled gaps left by weak exports. Currency defense took priority over industrial investment. According to insiders, this approach felt responsible and modern, even as it deepened dependence. History offers quiet parallels. Other mature economies followed similar paths when past wealth masked present decline. Debt delayed adjustment. Finance softened pain. The underlying structure changed very little. The question is not why Britain borrowed. The question is why borrowing became the default solution. When stability depends on confidence alone, what happens when confidence finally hesitates? The pattern did not end in the past. It extended into everyday life in quieter ways. Britain entered the new century with a service-led economy, a large financial sector, and limited industrial depth. Household debt grew steadily. According to public data, mortgages expanded faster than wages for many years. Rising property values replaced income growth as a source of security. Consumption remained strong, even as productivity lagged. Government finances followed a similar path. Deficits were managed rather than eliminated. Low interest rates reduced visible pressure. The system appeared stable because borrowing was cheap and widely accepted. After the financial crisis of 2008, these choices became clearer. Emergency support protected banks and credit flows. Ordinary life continued. Yet the reliance on debt had deepened. The long shadow of earlier decisions remained firmly in place. Britain's hidden debt story is not about failure. It is about trade-offs made over generations. Stability was chosen again and again, even when it delayed deeper repair. Other nations have faced similar moments. Some rebuilt production at great social cost. Others leaned on finance and credit to smooth the path. Britain chose the quieter road, and it worked, but only up to a point. Debt became a bridge across economic gaps. Over time, the bridge turned into the road itself. Growth mattered less than confidence. Adjustment was postponed rather than resolved. The question now is simple and unresolved. How long can stability rest on borrowing before renewal becomes unavoidable? For more than a century, Britain has answered that question by waiting.